If our Chief Legal Counsel, Barry DeGroot, is listening right now, we would say that definitely get, of course, your own tax and legal advice from some awesome folks like these up here on the stage. I am not a CPA, but was very fortunate enough to work with not only our team, but with Stewart and Kissel, the law firm that helped us draft the fund documents for the housing fund, as well as with Cohn-Resnick when it came to the tax portion. So I was involved with the fund formation, as it were, through that process. So what I'd love for us to do, especially since we have these wonderful experts and professionals here on stage with us, is talk about some of the benefits of the housing fund. And again, for some of you it might be a refresher, for instance, but for some of you, you might learn something new. And then obviously we'll check that against what our professionals here see, as well as what that compares to in the overall world of real estate investing outside of DLP, or in addition to DLP. So obviously you all, in many cases, have investments with us, but then also have investments outside, active investments and otherwise. So that's our goal here for this time. So the first thing, and Bo alluded to it, because of the fact that the housing fund is set up the way it is, in an evergreen nature, we talked about not having to keep your money locked up for 7 to 10 years and getting out in an annual fashion. But one thing I do want to make sure that we understand is that on the flip side of that, unlike previous funds that we've had or other funds that are out there that are closed-ended, meaning they have a shelf life of 3 to 5 or 7 years based on the documents and the strategy, and at that time you wind down the fund and you have to take your money out, which causes a taxable event, even if you roll it into another DLP investment, for instance. So for us, when we were forming the housing fund, what we really wanted to be able to do was give not only us the flexibility to buy and sell properties within the fund on our terms, but then for you as the investor, you don't have to wind down at any particular time. You can get in and get out as you need or want on your terms and on your timeline. So in some cases we have investors, for instance, who might have a business or they might have other real estate holdings that they know are in the beginning of a value add stage, for instance, and they're going to be taking operating losses that year. So what they might do is they might say, well, I have $500,000 in the housing fund or $1 million in the housing fund. I'm going to take a partial redemption this year because any gain that I might have is going to be offset by the losses in my big picture. So it's a great tool for you, not only for obviously the great returns, we talk about that all of the time, and the consistency and safety, but what we really want to highlight is the fact that you have flexibility within the fund to maximize your tax benefits as well. So the first way that we do that, number one, again, is we 1031 in and out of properties. So we have that flexibility. When we sell a property out of the fund, we can just 1031 into a new community, so maybe perhaps one of the ones that we're acquiring in the next month or so, where it then allows us to reduce the taxability of it. And as we talked about earlier, with the depreciation that comes along with owning properties, we're able to pass that through to you. So what we've seen is that you've been able to offset or defer your tax by up to, in some cases, 100% because of the fact that we're passing through that depreciation. Originally, when we started the fund, we kind of marketed it, or we put it together and structured it as potentially a hybrid of lending and equity in properties. We very quickly realized that we did not want to go down that road because one of the biggest benefits, other than the security and all that, I'll stop saying that someday, is the fact that that depreciation is going to help you with offsetting your income tax. And so when we look at adding loans to the fund, if we were to do that, that's going to presumably lessen that benefit because you're not able to obviously, there is no depreciation to pass through on a loan, for instance. So when we're going through that process, we said, well, look, we're going to continue to invest actively into properties. We can do loans, but we're not necessarily going to do that at all, so that we can maximize the tax efficiency of the fund long term. And so that's our, I guess, strategy overall at a high level, so you can get a glimpse as to why we're not doing any loans, or why we're keeping it as equity. So One of the topics that I'd love to bring you guys in on is the topic of depreciation. And we have had a number of questions about the topic of depreciation recapture. So again, not a CPA, not a tax expert. So what I'd love to do is basically have a high-level overview of how the depreciation itself works, and then in the fund structure itself, how would that work if you were to redeem out, say, in 10 years or something like that?
So, being the tax nerd, I'll start. So the great thing with depreciation on real estate is that you're getting the deduction for the depreciation at whatever your marginal rate is. So if you're in the 37% tax bracket, you're going to be saving, for every dollar of depreciation, you're going to be saving 37 cents. When you sell the property, it only gets recaptured at 25%, a maximum. So if you have a gain, that depreciation gets recaptured only at 25%. Then any excess gain, so I'll just put numbers to it. If you own an apartment and it's or let's say condo, for $100,000, you purchased it for $100,000, you took $25,000 of depreciation, and then you sell it after 5 years for $110,000. That $25,000 is going to be recaptured at 25% tax rates. The additional $10,000 would be captured at normal capital gain rates. Under current legislation is 20%. So there's an arbitrage, getting the deduction at 37%, but only having to pick up the gain at 25%. So that's favorable for the recapture.
I know that you became an expert in the fund itself overnight because you read through the documents, but how does that differ if, for instance, you're owning ownership shares like you are in the housing fund that are always at $1,000 per share, for instance, and the NAV or the asset value itself of the fund share is not increasing, or does it change at all?
So my understanding is that when you come out of the fund, it's not ordinary. It's still the recapture at 25%. So it's you're looking at the underlying assets.
Excellent. So that's a great point. And so when you look at kind of the strategy, I guess what that indicates is that you can have it as a short-term strategy. If you typically hold a property for a year or two, you can do the same thing in the housing fund. Or if you wanted to hold it for 8 to 10, 15, 20 long-term sort of holding, you can do that. What would in your experience, what has it been where if somebody does hold it longer term, do you find that the benefits of the depreciation are outweighed by the overall tax that you pay on the gain? I mean, even in that sort of arbitrage scenario.
I mean, there's multiple things, right? So there's the return on the investment. I mean, so I was reading through how the returns get allocated between the manager and the members. So you have to weigh that in. You can't just look at the tax. So you have a good return on the investment. Holding it long term. So when you use 1031 within the fund, you continue to kick the tax can down the road. So it's a great strategy, but to the extent that the fund is putting more into a new property, this value add, that continues to add depreciation. So they'll continue to get the benefit.
Thank you for that. Yeah, because unlike even a fund that has maybe 1,000 units or $10 million or 50, whatever the number is, and it closes out and has to wind down in 3 to 5 years, it gives a lot of flexibility, I think. Good. On the topic of 1031s, I know we wanted to talk through maybe some of the ways that investors can invest in the fund as far as, we have the land example, for instance. Could you explain a little bit about that side of things and how that might affect an investor in the room?
Sure. So if I own a strip mall and I'm tired of being the landlord and being responsible for repairs and all of that, and I just want to go collect my check, I can contribute my strip mall investment to the housing fund. They will assist me in doing a 1031 exchange so that I'm not paying tax. Because theoretically, let's say I've owned it for 30 years, I've depreciated that building, so my basis is very nominal. I would have a significant tax burden. By doing the 1031 exchange into the fund, I'm not paying tax on the gain. My basis in the fund, though, is still whatever my basis is in that strip mall. It just carries over. And so it would be when I exit the fund.
And I guess as far as, when you're looking at the different kinds of funds you see or the different kinds of real estate investments that you see in your clients' portfolios, can you talk about some of how you see the housing fund being similar versus, what are some of the major differences versus what you see traditionally out there in your clients' portfolios?
Okay, so
You're on a roll.
I was talking to someone else earlier about the housing fund, and I have, because I practice with high net worth clients, I actually have a lot of clients that invested in opportunity zone funds this year, and where they actually did the partnership themselves. So there's different structures that you can use. But the opportunity zone fund is similar to the 1031, except it has a finite life. With the Opportunity Zone Fund, I get to not pay tax right now, but everyone who did an Opportunity Zone Fund will have to pay the tax at the end of 12/31/26. Okay, that's just the way it was set up. There's some benefits to it. Excuse me. I have one client that has invested $99 million. I mean, he just had some significant gains. So the tax savings of doing that structure, I mean, the time value of money on the deferral is significant on $99 million. Go back to your question because I'm going off track.
Of course, so the similarities and differences of the housing fund itself versus other investments.
Okay, thank you for getting me on track. So the thing that they were looking for in the Opportunity Zone funds, they were normally investing in student housing, right? All these great communities going up around all of the colleges, and then COVID happened. And students are at home. They're not there. And these expensive multifamily apartment complexes, whatever, are not doing as well. But what the asset class that the housing fund is invested in is where that is being successful because it's affordable. So that's where I see the growth happening.
Excellent, thank you. So I know we're going to talk about the industry at large, I suppose, and the tax efficiencies. So I'm going to wrap up our portion with the housing fund here shortly, but before I do, I'd like to open it up. I know we have, of course, a number of folks here who are already invested in the housing fund, but some who may not be as familiar with it. So I'd love to open it up for questions for the panel here or for myself, anything that we can answer. So, Kevin. Hey, Brad, do you guys have a mic back there?
I've got a lot of voice. You don't need
I can hear you.
I kind of ran by you earlier. I'm waiting to have my funds move over from the lending fund over into the housing fund so I can get it in there. But my source of funding are IRAs, both Roth and traditional IRAs. How can I benefit on the depreciation aspect of that, knowing that my Roth is tax-free and my traditional is tax deferred? Is there any benefit why I take that depreciation applied to other income sources that I have?
Sure, so I'll just reframe that a little bit, Kevin. Thank you very much. So the question in general was, if you're using sort of a qualified account, an IRA, traditional or Roth or other qualified accounts, how how can you, and if so, can you utilize the depreciation with other income streams? So if you're earning gains or you're earning regular income outside of DLP's fund investments, can you then, if you can, credit the depreciation to those, as well as, in general, are there any additional, or can you utilize any additional benefits from depreciation if you're investing in an IRA?
Yeah, we're just going to keep punting to the girl. So,
Say it depends. Say it depends.
Yeah, my attorney advised me to say that it depends.
There you go.
Thank you. I honestly, it does depend. I would not be thinking about putting a traditional IRA into something that is going to get a K1 with depreciation. I mean, there's value there for sure, but that cash flow is not coming to you. The Roth would be different. So, I mean, we can talk offline because I think that's a very specific question.
And then to the second part, as far as if someone's earning depreciation from investment A, you know, the housing fund, for instance, but they have taxable income from investment B, whatever that may be. In your experience, have you seen that depreciation from investment A being able to be credited to the other income, or is it specific only to that same investment? And for instance, if there's excess, do you forfeit that, for instance, or lose that?
So to your question, yes, you can have multiple investments and having depreciation, like reduce the income on one, can be netted, all your passive activities. What's different there is that that's an IRA where it's not coming into your tax picture, your current annual tax picture.
And you made a great point there. So you mentioned passive activities. Can you clarify, for instance, if somebody is a W-2 employee still, for instance, that regular income versus passive income and how that all works?
Sure. So the IRS Code Section 469 defines passive activities. If you're a W-2 employee, it's very difficult if you're working full-time to say that you are a real estate professional, which is where we're usually looking at passive and active, or it's actually non-passive, so passive and non-passive status. If you are active in real estate, it allows you to take losses against ordinary income. So that's the favorable tax treatment of being a real estate professional versus a real estate investor. It's going to just come through passive. You've got limitations. If all of your investments are generating passive losses, then they can be limited because you don't have any passive income. They're not lost, they just get suspended until a year in which you have passive income or dispose of the asset or the investment.
Awesome, thank you. So I think we have Barb, and then we'll go to Chris.
So on the 1031 exchanges, you're deferring any capital gain, kicking the can down the road. When and if do you, as a fund, pay the piper? When and if do we, as investors, pay the piper?
So I would say it depends on how it's titled. So if you own that like in your living trust, it would be eligible for a step up in basis at your death. Otherwise, if you dispose of it during your life, that's when the gain would be recognized.
Great question.
Chris, I got it. Larry, good job. So the last two questions kind of segue nicely into this, I hope. So assuming mid-January we're under a Biden administration, one of the things he's talked about is what can happen to and what can be changed with respect to 1031 exchanges. So he's been threatening to do that for the last year. What do you reasonably expect to be the outcomes, especially given the fact that it looks like it's going to be a split Senate or a Republican Senate? And how do you think that's going to impact the folks in this room here?
I am gonna kick that to them, but I will say that having a Republican Senate is gonna make it more difficult for Biden to make major tax law changes. With everything politically, it's negotiation, it's compromise. If you want to build that bridge, we'll give you this. So I just would say that it's going to be more difficult if the Republicans maintain the Senate.
Yeah, I can give these are political guesses at best. But I think Tammy's exactly right that with a split administration, it's going to be really tough to get anything, especially anything substantial done, especially in the first year. So there is potentially time. I don't know how much time, but it doesn't look likely that something would get passed in 2021 and be retroactive to the beginning of the year. But there are certainly strategies and considerations where do you want to, with lower rates, is now the good time to accelerate some gains at a lower rate? When do you want to start taking deductions? So those are things to think about when the picture becomes a little bit clearer. And then to a final point, when you do have a split administration, there tends to be more executive action, which can be more plentiful but less powerful. So things may be enacted through Treasury regulations versus change to the actual tax code. So even with it, there is some ways for a Biden administration to get their way on some things through other type of action.
Okay, thank you for that. I have a quick question. So, how many people here get a K-1 from DLP? Okay. How many people here, bought an airline ticket or paid gas to, had expenses in getting here? Okay. Tammy, correct me if I'm wrong, but that is, we should all be tracking those expenses because on the K-1 we can deduct those. Is that accurate?
My attorney would tell me not to answer that question, I think. But generally, Bo, yes, you would, to the extent that you are making expenses to produce or preserve income, but there's a fine line on, like if I just have a Merrill Lynch account, that goes on Schedule A, and right now doesn't exist until 2026 again. If I have a real estate investment with DLP and I'm coming to learn more about what DLP is doing, yes, I would offset it.
And what about for a 1099 is the same, because there's...
No, because the 1099 is interest or dividends,
Okay.
right?
Okay.
Yeah, so those expenses would go on Schedule A, but I would be aggressive and take a position if I was getting a K-1.
Okay.
Not all CPAs are the same.
Hopefully that's, that's something that people are taking note of. Krawchuk, yeah, you got someone back there?
Okay, I have a question about 1031. For example, I'm buying a property and then I'm selling it 10 years later with $100,000 profit. And I do 1031 exchange, which means I'm not paying taxes, right? Then I'm buying another property and 2 years later I'm selling it for no profit. What happens with the 1031 exchange? I'm not paying any?
So I think Ted, what you're saying is if you're buying a property and then you sell it for a profit. Without profit. Is there any, benefit to doing a 1031 or is there any reason to do a 1031?
What I'm saying is, the first time I rolled over 1031 exchange, but the second time I didn't pay, first time I didn't pay any taxes, but I'm buying another property 2 years later and not making any money on it. That means there is no capital gains, right?
So it depends. So you had the $100,000 of gain, but you did a 1031 exchange, which means you didn't pay tax on the first sale, but whatever your basis was in that first property is your basis in the second property. So it's not what the value of the property was, it's whatever your basis in the first property was, plus any additional cash or assets you put into that second property. That's what I'm comparing. So if that is equal to what you sold it for, then you would be correct. There would be no tax.
Okay. Other questions?
I kind of still do not understand this. So if I bought the property and I made $100,000 after 10 years, right? I did not pay any capital gains. Then I'm going to liquidate I'm buying another property. I keep it for 2 years. I did not make any money on it. I sold it for no profit. I'm not paying capital gains, right? Or do I pay capital gains when?
Here, what I think that you're looking at on the second sale is that you sold it for 300 and you bought it for 300.
Right.
But what you bought it for, because you rolled over your first property, maybe your first property, you bought at 500 and sold at 600. That's your 100,000 of gain that you're not paying tax. And part of what you did, I guess really I should go the other way. Sorry. You bought the first one for 200 and sold for 300. Okay, so you have a $100,000 gain. You roll it into a new property, okay, that you bought for 500 and you sold for 600. You rolled over a $200,000 basis. You rate your first property you bought for 200 and sold for 300. So you rolled over only 200,000 of basis into that other property. So that 200 plus whatever you put into it, if you bought it for 500, you would have had to put 300,000 additional in. So if you sold it for 500 and you put 500 in, then you have no tax. You have no gain.
I see. Okay, thank you.
So one kind of fun story. You can tell Tammy knows her stuff. So one time, Tammy and I were driving to an event and the speed limit was 65 and Tammy happened to be going 70 miles an hour and she got pulled over. And after about 20 minutes, she let the cop go with a warning. So, we don't mess with Tammy, okay? So, with that being said, we have more tax to talk about, but before we do, we have Chris Ryan, who is going to do his magic. But so Chris Ryan, do you mind going and getting a mic and getting ready and stuff? Is that okay, bud?
Oh, I got this.
Okay. But before we do, why don't we give our panelists a round of applause.